If you want to save money on taxes in Canada, make sure you do these 5 things before December 31st, 2025. Hey, if you're new here, my name is Michael Lee Kim, and I'm a financial coach, CPA, and TEDx speaker. And my goal is to help you learn how to retire young, not old, all while enjoying life. Let's get into it. The first thing that you need to do before the year ends is something that will save you thousands of dollars. But the thing is, most people get it wrong. And it all starts with the RSP. The RSP, also known as a Registered Retirement Savings Plan, is an account that defers your taxable income in the current year into the future when you withdraw from your RSP. And the benefit of this is that let's say you make $200,000 and you're at a 40% tax rate. Well, if you contribute $30,000 into your RSP, you would get a total tax refund of $12,000. The RSP contribution limit is the lower of 18% of your earned income, or about $32,000 as of 2025. But you can carry forward any unused contribution rooms into the future. Now, although the RSP contribution room deadline for 2025 is actually March 2nd, 2026, not December 31st, 2025, you really shouldn't wait last minute to contribute to your RSP, because sometimes it could take a few business days for the transfer to actually occur. Something that you should also consider is that you shouldn't just blindly put money into your RSP, because eventually when you have to withdraw money out of your RSP, you'll be taxed on it. You see, at the age of 71, you actually have to convert your RSP into something called a RIF, a Registered Income Fund. And as a RIF, you're forced to withdraw a certain amount every single year. And in some cases, you can actually push yourself into a higher tax bracket. For example, one of my clients was maxing out his RSP every single year. But when we did some calculations, we actually realized that he would be in a lower tax bracket today than in the future because he had so much money in his RSP. And so this is the reason why we decided to stop contributing as much to his RSP, where although he'll pay more taxes today, he'll pay less taxes in the future and overall. And this is the reason why you need an early retirement plan, so that you can figure out how much should you actually contribute to your RSP for 2025. And if you want to start building your own early retirement plan and figure out exactly how much you'll need for retirement, then get access to my free early retirement calculator. I'll leave a link to it in the description below. The second thing that you need to do before the end of the year will save you a lot of money in taxes and a whole lot of other things. You see, one of my clients was planning to buy her own place in 2026. Now, to buy her place, she's using about $100,000 from her TFSA. And in mid-2026, she's getting an inheritance of about $100,000. And so what she was planning to do was to take out $100,000 from her TFSA in 2026 to buy her house, and then refill her TFSA in 2026 when she got her inheritance. But this is a big mistake, because how the TFSA works is that the TFSA contribution room that you have is based on your age. And so if you were born before this date, you would have a total TFSA contribution room of $102,000. Now, you can carry forward any unused TFSA contribution room, but if you withdraw money out of your TFSA, for example, to purchase a house, you have to wait until January 1st of the next year to recontribute that amount. And so on January 1st, 2026, my client would get an additional $7,000 in her TFSA contribution room. Then she would withdraw $100,000 out of her TFSA to buy her home, which means her annual contribution room would only be $9,000, not $109,000. And so if she contributed another $100,000 into her TFSA when she received her inheritance, she would actually be over contributing to her TFSA and find a penalty of 1% per month. And this would be the total penalty that she would have to pay. And so instead, what she should do, if she plans to buy a house in 2026, is to withdraw money out of her TFSA in 2025 first. Then on January 1st, 2026, her TFSA contribution room will reset. And then when she receives her inheritance, she can put that $100,000 back into her TFSA. This way, she's still able to use her TFSA money to buy her place and avoid any penalty fees. And this is why with my clients who typically want to restructure their finances and investments, the best time to do this is before the end of the year. Instead of having to wait the whole year, you only have to wait a few months for your TFSA contribution room to reset. And this is why it's really important to know what are all of the tax deadlines so that you can plan accordingly. Another thing that you should do before the end of this year will save you thousands of dollars, especially if you're planning to buy your first home. The FHSA, or First Home Savings Account, is an account where, similarly to the RSP, any contributions to your FHSA is going to reduce your taxable income for the year. But the thing is, there is a limit to how much you can contribute to your FHSA. There is an annual limit of $8,000 that you get each year from the first year that you open up your FHSA with a total lifetime contribution room of $40,000. And so assuming you're in a 40% tax bracket, if you contribute the full $40,000 into your FHSA, you would get a total tax refund of about $16,000. And if you're planning to buy a house with your partner, they can also do the same thing. So you would get a total tax refund of $36,000. That's a decent amount of change. Now, the key thing is that you can only carry forward 1 year of unused contributions in your FHSA. So let's say in 2025, you open up an FHSA, but you don't make any contributions to it. Well, you can still carry forward $8,000 into 2026. Total room for 2026 would be $16,000. But let's say you don't make any contributions in 2026, your contribution room for 2027 is still going to be $16,000. You can't carry forward any more than $8,000 of unused contribution rooms. And that's the reason why for my clients who want to buy their first home, I typically advise them to max out their FHSA first before their TFSA or RRSP, so that they can max out and get the full tax refund for their FHSA. Because unlike the FHSA, with your RRSP and TFSA, you can carry forward any unused contribution room indefinitely. Now, I know a lot of people who ended up not using their FHSA and ended up losing thousands of dollars because this is something that you can only use to buy your first home. And once you've already bought your first home, you lose this benefit. And remember, you can't just throw $40,000 into your FHSA because it will take about 4 to 5 years to fully fill up your FHSA, which means you need to plan in advance if you're planning to use the FHSA to buy your first home. And this is why whether you're planning to retire, buy a house, or really do anything, you need to have a financial plan. The next thing that you should do before the end of the year could turn a really bad situation into a blessing in disguise. Let me explain. Before working with me, one of my clients made some really bad investment decisions and ended up losing a lot of money. But luckily, this could actually be used to his advantage. Because capital gains, which is any income that you get from the sale of an investment, can actually be offset with any capital losses, which is if you lost any money on the sale of any investments. And so how capital losses work is that you can carry forward any capital losses into the future indefinitely, but you can only carry forward any capital losses backwards 3 years. For example, let's say you sold a rental property 2 years ago and triggered a capital gain of $200,000. Well, assuming a 40% tax rate, you would pay total capital gains of $40,000 because only 50% of the capital gain is taxed. But let's say you sold some underperforming stocks this year for a total capital loss of $50,000. Then you can offset your capital gains by $25,000. And assuming an average marginal tax rate of 40%, you would get a total tax refund of $10,000. And so the taxes that you would normally pay would be $40,000, but if you utilize your capital losses, then you would only have to pay $30,000 in taxes. And this is how you can make a really bad situation into a not so bad situation. Obviously, it's not ideal losing money from your investments, but this is a way that you can offset some of the negative impacts from a not so great financial decision. And this is why it's really important to learn how to make educated financial decisions from the beginning, because it's always a lot easier to start off on the right foot rather than trying to recover from a bad financial situation. The last thing that you need to do before the end of this year is probably the most important thing to do, but often overlooked. You see, when I worked in corporate finance at a big fintech company, every single year we would have to prepare this big financial plan. And the reason why we did this is to help the organization as a whole stay accountable to achieve their financial goals. But ironically, people spend days and weeks creating a financial plan for their organization, but don't ever take the time to create a financial plan for their own financial situation. And this is why years go by and many people don't make any progress towards their financial goals because they don't have a clear plan for their finances. And this is why before the end of the year, you need to build a financial plan. And the financial plan is quite simple. All you need to do is to set your point A, aka your net worth and current financial situation, and your point B, which are your financial goals. And all you need to do is build a plan to get from point A to point B. And the benefit of having a financial plan is that it will tell you exactly what you need to do to achieve your financial goals. And the best time to start building your financial plan is before the end of this year so that you can start off the new year on the right foot. And so if you want to learn how to build a financial plan so that you can retire young, not old, all while enjoying life, then apply to work with me in my coaching program, the Early Retirement Fast Lane. To apply and learn more, I'll leave a link in the description below. And so here's a summary of all the things that you need to do before the end of this year year so that you can pay the least amount of taxes and achieve your financial goals faster with less effort. And as you might have noticed, when you learn about how taxes actually work in Canada, you're able to make and keep a lot more of your money. And this is why it's so important to learn the rules of the game so that you can use these rules to your advantage. And so if you want to start learning about how taxes actually work in Canada so that you can keep more of your money, I created a whole tax playlist. And so feel free to watch it right over here.